big corporate story in South Africa this morning is the trading update from Richemont, which has disappointed, apparently. Well, not apparently. The JSE has punished the share. It was down around about 7.5% at its worst, I think. Let's have a quick look at the headline of that. Luxury goods group Richemont, maker of Cartier jewellery, it says here, gave a cautious outlook on Monday after slowing wholesale demand for its pricey products. Again, this is the words of the report I'm reading. Pushed sales growth in the last quarter below forecast. Sales rose 5% at constant exchange rates in the 3 months to the end of December to 2.862 billion euros, missing forecasts for a 7.6% rise. On the telephone now is luxury goods analyst from RenCap, and that's Ray Wiem. It's quite a miss, isn't it? But then expectations, Ray, are particularly high. Are you disturbed by this?
No, I mean, the numbers were worse than what we expected. And if you basically just look in which regions were the slowdown, it was particularly in Asia, which has always been the growth driver. I mean, they actually recorded no growth in the quarter, as opposed to in the first half where sales grew 9%. So I think that is one of the reasons, for the drop in the share price today. And also sales in Europe slowed a bit, also a bit worse than what we expected.
If you have a look at the pie chart, if you could give us a verbal pie chart of the earnings of Richemont by region, if you like, is it still the emerging markets, the Asian markets, and particularly China, that dominates at the moment?
Yeah, that's true. I mean, if you just look at the sales makeup, I mean, Asia, excluding Japan, is about 42% of the sales, and the European region 35%. So those are the two major regions.
So when we see an increase of 13% in the Americas, although it's a very encouraging sign, it's actually small in the big picture.
Yeah, the Americas represent about 14% of sales. That to us was sort of, the highlight of the numbers. I mean, actually the sales growth accelerated despite a high base. Now, I don't know if it's just once off, or if it's an indication of things that may come. But I think what we'll see into 2013 is, the slowdown that we have seen in Asia. I think that should start to turn clearly, because I just think the retailers just had too much stock, so that's why they're postponing watch sale, watch orders from the watch manufacturers.
Is there a case to be made as well, Ray, that last year there was all sorts of talk about a hard landing in China and GDP growth on a year-on-year basis dipping below 7.5%, and of course last week we had a 7.9% print for the quarter just passed, which is very encouraging. So there's a lag effect here. As China starts to pick up again, that has a whole knock-on effect on the whole region, and we'll be back to business with Richemont in the future.
Yeah, that is basically our view. So it's more towards the second half of the next financial year. But the flip side of the coin is probably that you will see that the exceptional growth that you had in Europe, that should start to slow, just purely because of the link with travellers, and you had price increases as well as a euro strengthening, which makes it less appealing for the travellers to buy products in Europe, and maybe that could shift back to Asia.
So the currency factor very important for the European sales. When you see the European sales, you think of people in Switzerland and Paris and Milan going out and buying a Richemont product, but in fact that's not the case. It's people that have travelled to Europe from Asia and Southeast Asia, China, and filling up the shops, like you see at the January sales, for example, in London.
Yeah, no, that is correct. I mean, Richemont indicated at the interim results that 60% of the European sales are now to travellers.
How about the potential joint venture between the world's largest jewellery chain, which is a Chinese operation, and Richemont? Is this something that, could it happen, and if it does happen, is it a good thing, or does it sort of dumb down the Richemont brands?
Well, there's been no comment from the company on that. So at this stage, you must just sort of, take it as market speculation. But I mean, if you read the newspapers this morning, it's actually only referring to one specific brand, which is Bar Messier, which is a loss-making brand. So that in itself is, I won't, read too much in that.
Very quickly, the very sort of knee-jerk reaction of the market this morning to this latest update, do you think it's unjustified? And if so, do you think that we should be taking advantage of this and having a nibble at this stock?
Well, no, I would probably say it is justified. If you just look where the share price was in about October, if you just look at the Swiss franc price, that has gone from 56 to close to 80. So the multiples are quite high. So obviously, any bad news will make the share price prone to adjustment. So I just think maybe one still needs to be a bit more cautious on the stock at this stage.